Hello and welcome to IPO Adda. My guest today is Rituraj Sinha, Managing Director of SIS. Ritu, thank you for joining us on IPO Adda.
My pleasure.
To begin with, I know it's an IPO. You are in a very niche area of securities and security services. Can you give us a brief of your company?
Well, SIS is India's largest integrated business services organization. We are roughly 4,600 crores in revenue in FY17. We employ 1.5 lakh plus people as permanent staff, operate through 251 branches covering 630 districts of India. SIS services more than 11,500 customer sites. So that's the scale of the organization, and we operate three segments: security services, cash logistics, and facility management. Across all these three segments, we have strong market positions. We are number 2 in India in security, number 2 in India in cash logistics, and number 4 in India in facility management. In fact, what's more important is that organically, we are the fastest growing company across security, cash, and FM for the last 5 years back to back.
Rituraj, let me come to the question directly about margins. Your margins have improved in the last couple of years, but what is the kind of potential you have within this business? Because and how difficult it is to pass on the manpower cost, because manpower is the biggest source and biggest cost for you as well.
So let me take the second part of your question first. I think it's fundamental to understand that in our line of work, any statutory change is a pro rata pass through that is built into our contract. So there is no single contract that SIS Group has where the bearing or implication of a minimum wage change or a GST change is going to hurt our margins. For us, the way our pricing is built, that's entirely a pro rata pass through to the end user, who is the client in this case. Coming back to the first part in terms of margin, I think different businesses in our group are at different phases of development. For example, the security services business, which is largely built out now in India, for the last quarter of FY17 did a 7% EBITDA margin. So that's like a business that's sort of built out. The FM business this year on a revenue base of 400 crores did a 4.4% EBITDA margin. In the preceding year, they did a 2.5% EBITDA margin. So as they are scaling up, their sort of operating leverage is kicking in. So that's the case with most businesses. As these businesses build out, over the next 2 years, 2 to 3 years, I think the margin profile will shift.
So just a follow-up question on the facility management business that you have. How profitable is that business, and what are the growth prospects for this business?
Well, facility management is a humongous opportunity. I mean, I'll give you a very plain example. I mean, if you talk of the building we are standing in, if it will take X number of people to secure it and X number of cameras to secure it, it will take probably 5 times the headcount and 5 times the machinery to clean it or manage the facility, including HVAC and floor and all the other utilities that exist. So FM is a massive opportunity. We are building out a large FM play. We are already the 4th largest in India, and obviously the goal is to build out India's largest FM player. Yeah.
We have been talking about India, but you have a significant exposure to the Australian markets. So when you come to that portion, if you could tell us what percentage of revenue currently is coming in from that geography. And I was just looking at some Bloomberg data. It showed that the growth in Australia has been slowing significantly for the last 2-3 years. So if you could give us a perspective as to what kind of a growth prospect you see in that region and what kind of exposure do you have?
Well, our Australian asset on a standalone basis is a fantastic asset. In India, for example, we are growing 1.5 times market growth. So security market in India is growing at 20% year on year. We are growing at 30% year on year. In Australia, we are actually growing 2x Australian market growth. So the Australian asset is growth. Australian asset is also a great ROCE story. Standalone return on capital is more than 70%. It generates $15 million of free cash each year. So standalone, it's a great asset. But what's more important in the context of SIS is that Australia is actually the cash cow that is funding India growth.
Okay.
So with the significant amount of cash generation that Australia has each year, in addition, we've also leveraged the Australian balance sheet to raise $80 million of revolving acquisition finance line from National Australia Bank at 5% cost of finance. So we are getting not only the organic funding from Australia, we're also bringing in M&A funding into India from Australia. So Australia is literally the reason why the SIS promoter group is holding 75% stock in the company, because to fund Indian growth, had Australia not been there, we would have had to dilute equity much quicker to support that kind of exponential growth in India.
Okay, and since you spoke about acquisition funding, is there any target that you've identified in the Indian market, or any inorganic growth plans that you have to disclose at this point in time?
Well, I wouldn't like to get into specifics for understandable reasons. M&A is a part of our strategy. SIS over the next 3 to 5 years is looking to build India's largest security, largest cash and largest FM company under a common ownership. Now that's a pretty unique proposition even in the global landscape. And to be able to do that, we will have to do some strategic acquisitions. And we always have targets on radar, so I mean that's a part of business as usual.
That's one question which the street is also looking at, because you've been quite active in the acquisition space. Your last big acquisition was Chubb, which is MSS, which is the Australian subsidiary, and at that point in time it was 8 times your size. So are you going to be as aggressive in acquiring companies as you have been in the past, post IPO?
Well, let me correct you on data. Australia was not our last acquisition. It was our first.
I said one of the largest.
Yeah, Australia was our first acquisition that we made, and that was 9 years back. After that, we made 4 other acquisitions, and they've been strategic in nature. We have an internal investment policy. We have not acquired anything that has not given us an internal rate of return of at least 25%. And in the last 10, we've come across only 5 such transactions. So we will continue to acquire, but it must have a very clear strategic rationale. It must meet our financial parameter of 25% IRR. And for the moment, all acquisition focus is completely and entirely on the Indian market and the 3 segments in India.
Give me an idea of how your balance sheet and P&L will change, primarily because one, you're going to reduce your debt by 200 crores odd. So you have interest savings there, and second, the incentives given by the government of India with respect to labor hiring, any hiring below 25,000 per month, you get incentive there. How will it change the P&L for you?
Well, I mean, there's going to be a very substantial impact. Let me tell you that the 200 odd crores of debt that we are going to take away from the balance sheet post the IPO is going to have a very significant interest saving to the tune of 24-25 crores. In addition to that, the section that you are referring to, the employment generation incentive, is section 80 JJAA, and that section itself is going to impact, we estimate roughly 14 to 15 crores of tax saving on that count. So I think there's going to be a very substantial change in our PAT in FY18 and a corresponding change in EPS and return ratios.
Just a follow-up question on the debt. Post the IPO, the total debt, that is short-term and long-term, would come around close to 900 crore, which is still 1.7 times your equity and 4 times your EBITDA. So any further plans to deleverage the balance sheet?
No, I think for now, I think what we are doing is, is already stated in the DRHP, and for the short term, that's the plan.
So for 4 times EBITDA is sustainable for you, that's what I say.
No, I don't think we are if you look at our leverage right now, if you look at it from a net debt perspective, right? You're talking about a gross debt number.
Yeah, exactly.
From a net debt perspective, our EBITDA gearing is anyway 1.6 times. And after this repayment of roughly 200 odd crores, it will further shrink towards 1x. And I think that's a reasonable amount of leverage to have.
And most of it would be probably working capital.
Yeah, most of it is working capital. That's absolutely right.
What is the kind of working capital requirement which is required? Because in your business, payments are delayed, especially from clients. And one of the big features of your company is that you don't hold salaries of your manpower pending receivables from the client. So what is the kind of working capital cycle that you follow?
Well, to be very specific, we maintain in this industry's best DSO or receivable rate. Our security business has roughly 56 days of DSO. Cash business has close to 90-95 days, and facility management business has roughly 64-65 days of DSO. But more important than that is the fact that the fact that we actually take ownership of statutory compliances and other things differentiates us. Let's talk in comparison to some staffing companies. A service company like ours is responsible for recruitment, training, delivery of service level agreement, conditions, statutory compliances, and all other such things. And that's probably the reason why, on a per head per month basis, our India security business makes a margin in INR value, which is 3 times some of the staffing companies. So that's because we have a more comprehensive offering as a service company. I mean, that's the fundamental difference between service and staffing.
And how is the cash management business doing? Because especially after demon and reduction in cash usage, have you seen a slowdown happening there? Because there also, how many times you refill the ATMs is how you get the revenue from there.
Well, I mean, firstly, in the context of this IPO, the cash business is roughly 3% of our revenues, and it's a fractional part of our profit profile. So it's not a business that's going to fundamentally impact FY18 or FY19. But having said that, yes, demonetization did have an impact on the cash business because of limited currency in circulation, and there were challenges in number of replenishments we got. But since March, I think we are coming more or less back on track. So the number of replenishments, etc., are more or less coming back in alignment with what they used to be September last year.
On growth, sir, your revenue grew at a CAGR of 15%. Do you expect the same growth level to be maintained going forward?
Essentially, SIS is a high growth, high ROCE story. So we have maintained growth of 15% for the last 5 years. But if you break down this growth, the Indian side of the business, which is now more than half of the business, and over the next 2 years will become more than 75% of the business, has been growing at close to 30% year on year. At the same time, we've maintained a return on capital employed of close to 30% for the last 5 years. So that's pretty much the profile that we've maintained, and that's what we aspire to do going forward.
On Indian business, which will be your main focus, the security, facility management service, or the cash logistics?
Well, the core focus right now is security, followed by facility management. As I said, cash logistics is an important part of our play, but it's relatively small in the whole context at the moment.
So when you spoke of strategic acquisitions, which are the areas which you're looking at?
Well, like I said, our strategy is to build out India's largest security, largest cash logistics, and largest FM company in the next 2 to 3 years. So we will look at organic growth across these 3 segments, coupled with strategic acquisitions. And that's been pretty much what we've been doing for the last few years as well.
So basically, whichever project gives you a 25% IRR, you just go ahead irrespective of the sector.
No, I think let me define what I meant by strategic rationale. We basically look for 3 things. Either the asset has to give us a certain geographical advantage, it has to be sort of strengthening our market position in a geography, or it has to give us a certain advantage in terms of a customer segment that is under-penetrated for us, or it has to give us a service addition that we didn't have in our portfolio. Unless it meets one or more of these conditions, we don't even pursue the acquisition. And our acquisition story is validated largely. DE Shaw has been an investor in SIS, and they have seen some acquisitions. CX Partners has been an investor in SIS as private equity. They have validated our acquisition thesis. In fact, I must tell you that if you look at our anchor book, apart from the biggies like Adda and Reliance Mutual and Birla Mutual, one of the great things is that DE Shaw, which was our investor, first private equity investor between 2007 and 2013, they are coming back on our anchor book. So that's a big endorsement for us, and we're very happy about that.
Rituraj, final question. There is a political risk associated with the IPO because your family has close links with the ruling party. How do you address that link for the investors?
Well, our business and politics have nothing to do with each other. I mean, I joined this business in the year 2002. We were a 22 crore company that year, and over the last 15 years, largely, in different states, different governments have been in power, in center, different governments have been in power. But our business has grown regardless, because I mean, there is no linkage to any, political setup. Our business runs entirely independently. In fact, you must also understand that less than 5% of our revenues come from government contracts. So we really don't have a government linkage in any materiality.
Rituraj, thank you very much for joining us on IPO Adda, and wish you all the best for that.
Thank you so much for having me. It's a pleasure. Thank you.
you.